Hey guys, Reese here and welcome back to my channel. And today we have a pretty good video in my opinion planned. Real estate or stocks? It has diehard believers on either side of the coin as to which asset is the best investment class to put your money into for long-term wealth generation. And while there is different levels of effort involved, whether you choose to invest in the stock market passively, day trade, or real estate, actively invest in real estate, whatever, today we're going to compare the 10-year return on passively investing in the stock market and relatively passively investing in real estate. And now, while most of you know that I am a diehard real estate fan, I believe it is by far the best way to generate wealth and generate it quickly from very little money. I'm not blind to the advantages that the stock market has over investing in real estate. How easy it is to get started investing in the stock market. You can get started with literally no knowledge by investing in an index fund, maybe one that tracks the S&P 500. You can get started with very little money with Robinhood fractional shares, very little time, and still over time make a relatively good return on your investment. And this is a great place for many investors to get started. However, before you make that jump into the stock market, I think it's important to understand the long-term return on real estate versus the stock market and what you might be missing out on. So, as you get started in your investing career, if you don't have a job, you have no lendability, whatever, you can invest in the stock market and make some great passive returns. But maybe you get that first job and you've got your first $20,000 saved up. You have the option to choose between investing in the stock market or maybe buy that first property. And so today, for those of you who are kind of at that crossroads, let's take a look at the return difference between real estate and the stock market over the course of a 10-year investment. And now we'll compare three different categories today: investing in the stock market, investing in syndications, which is a passive form of real estate investing, and just straight up investing in rental property yourself, managing yourself, things like that. And I want to compare syndications to the stock market as well as other forms of investing in real estate, because syndications are a 100% passive way to invest in real estate. And so therefore I want to compare the returns from both 100% passive forms of investing. Now, what we're going to be talking about today is just comparing purchasing one rental property and holding for 10 years. And so that is truly, 90 to 95% passive as well. But I don't want any, stock market investors commenting angrily down below that, real estate isn't passive compared to the stock market and therefore returns can't be compared. So keep that in mind. So guys, once again, thank you for stopping by today. I'd appreciate it if you would go ahead and like this video if you haven't already, and consider subscribing to the channel. I'd love to see you guys around for future videos. I talk about mostly real estate, but I love to dip my toes into other financial topics. So thank you so much, guys, and let's dive right into the video. Okay, so let's set the stage. We are going to be starting in all three investments with a $20,000 initial investment. And for the stock market, dividends will be reinvested over those 10 years, but no other money will be added. Syndications, you can't really reinvest the cash flow in a syndication unless you invest in a new fund, but we're just going to forget about that for now to keep it simple. And then real estate as well. We're going to purchase one property and all the money in, closing costs, renovation, down payment, $20,000. That's all the money we have. We will not be reinvesting cash flow or cash out refinancing to purchase new properties. We're looking at purchasing one property over 10 years. So let's first take a look at the stock market. Now, we're not going to be talking about day trading today for one main reason. I don't know how to day trade. I don't know much about it. And a lot of new investors, I don't know if day trading is the best place to get started. Don't hate me if you think differently, but that's just my opinion. And so we're going to be considering investing $20,000 into, say, a Vanguard index fund that tracks the S&P 500, VOO for example. Well, the S&P 500 has averaged around 10.286% return, including dividends reinvested, since 1957, which is pretty much the modern day S&P 500 fund. Now, unfortunately, when you adjust for inflation, that number goes down to 6.4%, which is not ideal. And that's the problem with having these low returns, is that inflation just eats away at them. However, because I'm not adjusting for inflation on anything else, we're going to use that 10-ish%. That means over the course of 10 years, a $20,000 initial investment earning around 10.2% a year would then result in $53,000 and some change 10 years from now. That's a healthy amount of money. However, keep in mind $53,000 in today's purchasing power, so adjusted for inflation, is really only around $37,000. So you've kind of only doubled your money in today's purchasing power. However, not bad. Now, 2, syndications. Now, for most of us out there, we're non-accredited, which means you're not earning $200,000 a year, you don't have a net worth of $1 million. There's some other stipulations you need to be aware of for that. Most of us, not accredited investors. And so you need to look for a Regulation A syndication, which means it's open to non-accredited investors. Or you could find syndications that allow sophisticated investors. We're not going to get into that today. I'll make a video covering all sorts of types of syndications and options you may have to invest in them if you're interested. However, one of the most popular Regulation A syndications out there is Grant Cardone's Cardone Capital. Now, Grant's funds have an average hold time of 10 years, which means you invest today, you won't see your money back for 10 years, besides monthly cash flow distributions. However, that works perfectly for our example. Now, Cardone Capital and all other syndications are 100% passive, which means we can pretty much directly compare the return from a syndication to the stock market because it's equal amounts of effort. Now, if we look at Cardone Capital's website, we see that they advertise a 15% internal rate of return, which, we don't have a long historical performance of Cardone Capital to show if that's accurate. However, we have to take some liberties here. We're going to assume that 15% is realistic and use that number. That means on a $20,000 investment, you're seeing a return of around $3,000 a year. This would include eventual appreciation that you'd receive at the sale of the property, as well as about 4 to 5% cash flow paid out monthly. That means your initial $20,000 investment would turn into $50,000. Almost the exact same as the stock market, but let's keep in mind, cash flow on Cardone Capital funds are around 4, 5, 6% annual paid out monthly. And the rest of that 15% internal rate of return is realized by appreciation at the sale of the property. And so you'd be receiving cash flow monthly that you could accumulate with new money and then reinvest in another fund because the limits tend to be, $5,000 minimum investments. And so we need to realize that cash flow is not reinvested in this example, but for the stock market, we did reinvest dividends. So actually syndications, if you were reinvesting that cash flow, would pull ahead a little bit here. I think this is super cool because those of you out there that want nothing to do with buying a rental property, you can search for maybe even a better Regulation A syndication, or if you're accredited, even better. And maybe diversify between the stock market and syndications as they're both 100% passive investments. Super cool, you can kind of bolster your return a little bit and hedge against certain downturns in the market. Third investment, which would be value add real estate. And now this is my bread and butter, guys. I love value add real estate. I'm particularly fond of the BRRRR method of investing, which is to buy a property, renovate it, rent it out, and then refinance it, and then repeat. And that's the key, is repeating. And so the returns we're gonna see in this example, they are lower because you're not repeating the process, cashing out on these properties, and really building your portfolio. And so over 10 years, in this example, we're just gonna purchase one duplex. However, over 10 years, you could probably purchase 20 properties by cashing out and rolling into the next. However, if you do that and keep rolling into new properties, well, it's not passive. And so I really want to keep this somewhat fair and show the most passive way to invest in real estate actively, which is to just buy one property. In most markets, investors look for the 1% rule. That means if you buy a $200,000 property, well, you want to see $2,000 a month in rents. And so guys, in today's example, we're going to be house hacking a $200,000 duplex that has gross rents of $2,000 a month, which is fairly indicative of what active investors look for. We'll put 5% down on this property, taking advantage of a low down payment owner-occupied loan. And I have personal experience with this, that a lot of these options don't have PMI or have what's called lender paid PMI, which is wrapped into the interest rate. And so a lender paid PMI loan like this will probably in today's market have a 3.65% APR. Now, if we look at this spreadsheet that I'm going to overlay on the screen here, we see that year one cash flow will be negative $640 a month, or around $7,680 negative. That's because you're living in one side and we're only bringing in $1,000 a month on the other side. However, keep in mind you're not paying rent here, which is probably saving you at least that amount. And now year 2 through 10, we're just gonna say you move out, you find someplace to rent. We're not gonna consider your living situation beyond this point. Maybe buy another property, who knows? However, year 2 through 10 is going to have the same cash flow every year. We're not going to raise rents. We're not going to, raise expenses. In reality, rents and expenses are going to go up every year with inflation. Rents will outpace expenses. And so, cash flow will go up a little bit every year. We're going to ignore that, even though that will make your return even better. Okay, so looking at the spreadsheet here, years 2 through 10, each year you're going to cash flow $3,700. 9 years of that is $33,381. And then we're just gonna go ahead and subtract off the negative from year one with you living in the property. That was negative $7,680 for a net cash flow over those 10 years of $25,701. However, now we need to consider the equity in this property. So over those 10 years, you've paid down the principal and had your tenants pay down the principal, which is indeed return that we need to consider, because if you just had, say, an interest-only loan and didn't pay principal on this mortgage, that would be coming out back to you in your cash flow. And so if we look at a amortization calculator here, over 10 years, your tenants would have paid down the principal of your loan, which is a direct equity in your pocket, by $47,216, which is just incredible. Now, next is value add and appreciation over those 10 years. So we see here by the spreadsheet, I'm budgeting $2,500 to just be spent on closing costs, and then $7,500 to be spent on, say, materials to then improve this rental property. You put in a little sweat equity, and I've seen it time and time again, you can at least double the money you put into this property. So that $200,000 duplex will now be worth $220,000. Now, this isn't even including if you, say, bought this duplex at $200,000, but it was substantially below market because you found it off market and it needs a lot of work, and you bought it for $200,000, but it's worth $250,000. I see this every day at my brokerage. This is very common, especially if you're looking for off-market deals. However, once again, we won't consider this because we're going to assume you're going to work with a real estate agent, buy an on-market property, and you'll most likely pay pretty close to market value for it. Now, years 2 through 10 will just appreciate by the average market appreciation of 3% a year on that new value of $220,000. And so by the end of year 10, your property is now worth $287,000 and some change. Just incredible, the power of real estate, leverage, and appreciation. So let's go ahead and figure out what your 10-year return is on this one duplex that you bought. Well, principal paydown and appreciation will be included in all the same return. It's just equity that you've built over those 10 years. And so we'll take the new value of $287,000 and subtract it from the remaining loan balance at the end of year 10. So that's $287,000 minus the final loan amount at year 10 of $142,000 and some change, which equals an equity of $144,000 built up over those 10 years. And then let's throw in the cash flow as well of around $25,000, and that equals $169,974. So your $20,000 initial investment has turned into around $169,000. Guys, this is one property. What if you cash out refinance in year 2 or 3 and then bought another property and then bought another property and just did 3 of those over 10 years? That would be incredible. You'd be well on your way to financially free and probably a millionaire as well if you bought a few extra properties. However, we're just doing this one property because this is mostly passive. You might have to spend about a month really searching for a great deal to buy, and then the rule of thumb is management will take you around 1 hour per unit per month. So you're probably, if you're self-managing, spending around 2 hours a month on this property. That is, in my opinion, passive. And keep in mind, we left out tax advantages completely, which is write-offs you can take against your active income if you're working a job, and increases in cash flow we didn't account for either. But even without including these, we're seeing an average annual return of around 75% on your money instead of the around 10% in the stock market. And now the cool thing is, and why real estate is such a hedge against inflation, is if we're seeing this 75% annual average return, well, take off 3% for inflation, doesn't matter because you still made 72% on your money, but you take 3% off that 10% that you made in the stock market, and that's a substantial hit to your money. And this is why it's said that 90% of millionaires are made through investing in real estate. Real estate has such wealth generating power, and I feel a lot of people don't understand. And it seems like investing in the stock market is just this easy thing. You can do it passively. And I'm not saying you shouldn't invest in the stock market a sum of money. However, not including real estate in your portfolio is a big mistake. We see all the time that people are reaching 60, 65 retirement age, and their retirement accounts are not nearly enough to live off of if they even have one. And yet you invest in maybe 1 or 2 properties over 40 years, that would push you substantially closer to your retirement goals and produce cash flow that you could live off of in retirement instead of some measly dividends that you get from the stock market. Guys, I hope you enjoyed this video comparing the returns from the stock market, syndications, and investing actively in real estate. And I'd love to hear your thoughts in the comments below. Are you guys considering adding real estate to your investment portfolio? Maybe when you get a job or have some money saved up to have that lendability to get into real estate? Or are you thinking the stock market's still only for you? And why is that? I'd love to hear your comments down below. So guys, thank you so much for watching this video. I really appreciate all of you. Go ahead and consider subscribing, guys. We're almost at 1,000, and I would love for those of you who subscribe under 1,000 to have those bragging rights when I hit 10,000 or 100,000 subscribers a couple years down the road. So thank you guys so much. I really appreciate it, and I'll see you in the next video.